to Sheila Bair about that, the former Assistant Secretary of the Treasury for Financial Institutions, also the former Federal Deposit Insurance Corporation Chair. I've also said of Sheila Bair, she was a remarkably calm figure at a time when, if I had been in charge, it would have been crazy. Sheila, very good to have you back with us.
Nice to see you. Thanks for having me.
You know, we have all of this volatility back and forth. There were rumors over the weekend, I'm sure you heard them like others, that another big bank, a world bank, Credit Suisse, came up that was having some financial problems with credit default swaps and all of that. You heard a lot of that stuff during the meltdown. How did you separate the reality from the frightening fiction?
Yeah, it's a good question, and I think it's hard to know. It seems like Credit Suisse problems is primarily in their investment bank with some complex derivatives exposures they have. Not a lot of transparency around that. So we had the same problem. Derivatives strike their come back in their ugly ways again. So it's concerning, when a bank in market conditions like this says that they're restructuring, they're going to sell assets, they're going to raise capital. They must be in need if they're going to do it with these market conditions. So I think that bears really careful observation. I hope they don't have to get bailed out. This will be a test of some of the post-crisis reforms, whether we've really ended some of this interconnectedness that creates pressure to do these bailouts of these large banks. I hope that's not where we end up with Credit Suisse. But I think it bears watching. And to be honest with you, I don't have a lot of confidence that we have reduced the systemic risks that are posed by these very large interconnected financial institutions.
But you're right. You're right to point out, though, that it's a creative bunch, these money guys, because they find ways to package or make money off something. Now, I don't know enough about this, whether it applies here, whether we have something to worry about here. But no matter how we try to rein in financial players, invariably one, and then it grows to others as contagions build. I'm not saying that's going to happen here, but they find clever ways around it.
Yeah. Well, and I don't want to be alarmist either. I think, at the end of the day, probably the Swiss National Bank or the Swiss government will have to, if there's going to be a systemic event, they're going to have to step in again, which is unfortunate because we were trying to end bailouts as part of our post-financial crisis reforms globally. So I don't know what's going to happen. But the complexity around these products, the fancy financial engineering, and who's left holding the bag, right? It was AIG last time. So it's not Credit Suisse this time. But there's a lot of complexity. And frankly, even sophisticated institutions like Credit Suisse do not always understand exactly the exposures they're taking on. You end up with surprises.
Yeah, we're always trying to test which institution is worth saving, which is not. I mean, the old too big to fail argument. Lehman Brothers was not deemed too big to fail, and it did. And AIG, or any one of the big money center banks was, and it didn't. So I know how that goes. But do you think with that bigger capital reserves and requirements that banks have more cash on hand just in case has mitigated that somewhat?
Well, I think in the U.S., there's been, we have better capitalization in the U.S. than we do with European banks. The U.S., to its credit, was much faster in getting its banks to recapitalize. So I think in the U.S., yes, capital levels are much higher. Whether they're high enough, I don't know. One concern I have, and I've written about this before, is that the Fed stress test this year, actually in their adverse economic scenario, assuming a recession, they did not test a rising interest rate environment. They assumed that interest rates went back to zero. I don't think that's going to happen this time. If we do have a recession, we're still going to have elevated interest rates, is my guess. So I think that stress scenario is something they need to look at. Maybe they're doing it quietly. They should do it publicly so we all know that they've run those numbers. And then again, the interconnectedness. There's so much risk outside of the banking system now. It always collapses back in through, counterparties or big clients, private equity, hedge funds. A lot of these asset managers, just not a lot of transparency, again, around what kind of exposures they have. They're all customers of these large banks. So we won't know, actually, until things start becoming stressed. One thing I think is important to point out is in the past, for instance, in 2008, 2009, that crisis followed. The catalyst was rising interest rates, but it was really the financial crisis, not the interest rates, but the financial crisis that really hurt our economy as banks pulled back from providing credit. So this is one of the reasons why the supervisory side of what the Fed does and these other central banks, this is every bit important as what they do on monetary policy. They have to keep this our financial system stable as they continue to raise rates.
Yeah, because you never know, right? History might not repeat itself, but oftentimes it sure does rhyme. Sheila Bair, great catching up with you. Thank you very, very much.